Hi, my name is Ron Matheson. I'm a Senior Vice President with WebsiteClosers.com. We're a boutique brokerage that specializes in representing savvy entrepreneurial sellers of online businesses, and today we're going to talk about valuation. Now, a lot goes into why your company is worth what it is, okay? We get, obviously every seller wants to maximize the value of his company. Obviously, every buyer wants to minimize it. We as brokers are commissioned. Obviously, we want to drive it as high as we can. Now, understand, there is a market range. We have sellers that have actually come to us and said, hey, we feel this should be a Dutch auction. And you put it out there and you're going to get tons of offers for it. We're just going to take the one that makes the most sense to us. It doesn't work like that. I wish it did. That would make my life very easy, but unfortunately it doesn't. There's a market range that goes into determining the value of your business. Now, a good broker will always drive that price to the high end of that range, and that's what we do. Now, let's talk about, first of all, the valuation. It comes through funding. If your company is easier to fund, your value goes up. We prefer going through the bank because then the funding process is complete. Now, the banks are going to look at the last 3 tax returns. They're going to look for the line items on the tax return that represent profit, owner's compensation, depreciation, interest, amortization, and maybe pension plans that went to you, or if you paid a family member and that family member really didn't do any work. Well, then obviously that's going to be a replacement cost, which we will factor in to the value of your company. Now, understand there's certain things. We're going to start with a multiple of 3. That's what your e-commerce company starts at. It's worth 3 times what those earnings are. Now, those earnings are called what we call SDC, which is Seller's Discretionary Cash Flow. That's Main Street's version of what Wall Street calls EBITDA. Now, essentially, the reason why your company would be worth more than 3 or less than 3 could come in through various factors, okay? It might be worth more than 3 if you have a long market tenure. You've been around for 4 or 5 years and more, maybe even up to 10. That's a big positive. You show double-digit growth increases every year. That's a big positive. Okay, if you have a product that's very mainstream and solid and everybody recognizes it, it gives comfort to the buyer. It doesn't mean your company's necessarily better, but there's a comfort that is attached to that. Also, if it's an easy to relocate or easy to take over company, that's consideration that a buyer gives to that company, which allows him to want to pay more. Now, on the negative side, that which will drive you down below that multiple of 3. You have a short tenure. You've only been around a year or 2. I mean, most buyers are going to look at it and say, why is he selling if he's only owned for this amount of time? And it starts to represent higher risk, and they get a little bit hesitant about wanting to offer anything as a normal multiple. The next thing would be if your product is not as mainstream. Okay, if you've got a faddish, whimsical product maybe that it's perceived as, and they wonder what the future of your product is, that's going to drive it down. If you have a lot of ad backs, that's a negative. If you have erratic sales, if your sales are a roller coaster, not so much. It gives pause to the buyer. They begin to get a little bit nervous about your company. Also, excessive inventory. Now, let's talk about inventory. Inventory is a big thing. A seller represents inventory. They say, hey, I should be getting 3 times plus my inventory. It doesn't really work like that. If you were an asset sale, and we were selling your equipment, your inventory, your furniture and fixtures and stuff, and it was just an asset sale, then that's what the value of your inventory is. But as a multiple of 3, it's no longer an asset, it's a goodwill sale at that point. So it changes the dynamics of the way we're selling your company. Now, inventory will give you more value than the 3, but you're not going to get a dollar for dollar value. A seller looks at it as a concrete, visible item that they've paid for, they know what they paid for, and they know what it's worth. Okay, that's not the case. The facts are, let's start with the first thing. Number 1, if your inventory is growing at a larger percentage than your sales, that's a negative in everyone's book. Okay, from my end, from the bank's end, from an evaluation end, it's going to be a negative. Okay, because it means you're booking profit based on beginning and ending inventory, not necessarily what you sold and put in your pocket. Now, understand why it can be a negative. First of all, That inventory might be something that you have to mark down to cost to sell. Well, obviously that's a problem. In some cases, below cost. And in other cases, you can't sell it at all. Therefore, it had no value. That's going to hurt. Now, let's talk about how you should treat inventory. Inventory should be treated as such. When a buyer buys your company, you need to leave him enough product so that when he hits the ground, he's going to hit it running. He's going to do just as good as you do, and he's not going to lose any steam because you did not leave him enough inventory. On the flip side, do not leave any more than a good, solid working inventory. You know that stuff that's been sitting there for a while, the stuff you do need to mark down, or just dump it. Because the bottom line is you're not going to get that value later. Get it before you sell it. I hope that kind of tells you a little bit about selling your company, and for more information on selling your company and evaluations, go to websiteclosers@youtube.com. And thank you for listening.